Primer on financial fees. There's a great story about a savvy Philadelphia retailer named John Wanamaker, who nearly 150 years ago realized that his customers and salesmen were wasting lots of time haggling over prices. He decided to try something creative and put clearly marked price tags on every item. Soon enough, this innovation caught on, and almost every business followed suit. The companies that didn't had good reason not to. They were making too much money from the ignorance of their consumers. Unfortunately for investors, financial products was among this group of notable exceptions. It's hard to evaluate anything for which the price tag isn't visible to everyone else. You can probably recall what you paid for a gallon of gas or a cup of coffee last week. But the data suggests that most people don't really know what they're paying for financial services. Cluelessness around fees. In a 2013 study on over 1,000 Canadians, researchers discovered that a shocking 25% of investors didn't think they paid their advisors anything. Another 19% thought they paid something but didn't know what that might be. In fact, in one study by the Ontario Securities Commission, it was found that 73% of investors believed that advisors would look out for their best interest irrespective of how they were compensated. And according to the National Bureau of Economic Research, most investors believe it's sufficient to consult with a product-oriented broker before purchasing investments that they are proposing. Warren Buffett said that this behavior is kind of like asking a barber if you need a haircut. Study after study has demonstrated that investors do not have a firm understanding of the actual fees they pay and what impact those fees have on returns. And since fees are largely unregulated, the onus of figuring out whether the fees charged are excessive is entirely up to the investor. Before we get to what fees would be considered outlandish, the more important question we have to ask ourselves is why exactly are fees so important? And why is understanding them so critical to our investing success? Why are fees so important to understand? The most obvious reason is that it's money out of your pocket. Studies show that in the US, nearly 25% of all investors' retirement savings will be eaten up by fees. In Canada, believe it or not, this number is actually closer to 50%. It's the only thing we can control. Investors have no control over returns, but you can control what you spent. You don't necessarily get what you pay for. There is no data that links high costs with outperformance over any meaningful period of time. And when it comes to mutual funds, Morningstar has reluctantly agreed that low fees are a more robust predictor of future results than even their own star system. Every little bit is big. Even a small difference in price can make a major impact. For example, saving just 25 basis points, a quarter of 1%, on a $10 million portfolio can buy you several years' worth of gas and coffee. Alignments of interest. The most important reason to understand fees is because they dictate what behaviors we're incentivizing. Time and again, it has been proven that for the best indication of someone's future behavior, whether in business, in sports, or in investing, it's rooted in how they are compensated and which behaviors are being rewarded. Advisory fees versus asset management fees. Before we discuss the range and variety of fees, we have to make a distinction between these two completely different fees: advisory services and asset management services. These two are often mistakenly conflated, but these two roles are as different as a doctor to a pharmacist. You wouldn't call your pharmacist to find out what's wrong with your sick child, and you wouldn't expect your family doctor to be in the business of selling you pills. Yet that is exactly what happens in finance, and it's largely a blunder of history. You see, before the 1980s, the large banks generally acted primarily for their corporate clients. At the same time, other institutions, such as investment dealers, brokered deals and created financial products. Banks offered no financial planning, no estate planning, no insurance, etc. That was done outside of the investment industry, mostly with accountants and other trusted advisors. As we moved into the late 80s, there were a number of legislative changes that allowed banks to start acquiring broker-dealers. So for example, in Canada, Bank of Montreal bought Burns Fry, and CIBC bought Wood Gundy, and Scotia bought McLeod, Young and Weir, etc. Obviously, this was beneficial for the banks, as it allowed them to increase clients, service offerings, margins, and so on. Though it was in the absolute worst interest of the investors, as it brought the foxes into the henhouse. Banks could now get paid for creating product with their corporate clients and get paid for selling it to their retail clients. Massive conflict of interest. This consolidation led to countless abuses. So when brokers started to get a bad reputation, they needed to rebrand themselves as financial advisors. This conflated the advisory and the asset management functions, such that today, almost every broker, every fund salesman, and asset manager will call themselves an advisor. Investors can no longer distinguish what they are paying for, and the industry has taken full advantage of that. As opposed to inspiring a culture of stewardship, financial services has evolved into a culture of salesmanship. To avoid the confusion the industry has imposed on us, it is imperative that investors decouple their asset management fees and their advisory fees. For that reason, I'd like to tackle them one at a time. So let's begin with advisory fees. Advisory fees. These are fees charged for a variety of services, such as developing an investment plan, educating investors about various investment vehicles or opportunities, monitoring and rebalancing portfolios, managing liquidity needs, and generally providing clients with peace of mind. Developing a holistic financial plan, creating an optimal asset allocation, implementing the plan, advising on new opportunities, educating clients, monitoring investments, managing cash flow needs, providing clients with peace of mind. Typically, advisory fees are paid in 5 ways. It could be either based on the transaction, based on assets under management, based on a project, based on time, or some combination of the above. Transaction-based, AUM-based, project-based, time-based, hybrid. Let's delve into each of these individually. Transaction-based compensation. The transaction-based model is where the advisor charges you per transaction. These transactions can be upon purchase, upon sale, or as a trailing commission on retention of assets for some period of time. The cost of transaction may be different advisor to advisor, even those within the same firm. So shopping around goes a long way. They are also often different for different vehicles. For example, buying an individual security may have one price, while buying a fund would have another. Challenges. I believe that the transaction model is one of the most problematic and one that's most likely to eventually be extinct. There are many reasons this model is problematic. Let's start with the fact that studies at Harvard have shown that buying funds from those who are compensated by the products they sell actually translates into poorer performance even before deducting the additional fees related to the compensation of the advisor. Further research on German investors demonstrated that commission-compensated advisors tend to increase portfolio risk, increase the probabilities of losses, and increase portfolio turnover. Lastly, transaction fees are harmful because they simply encourage more transactions. As researchers Brett Barber and Terence O'Dean have unequivocally proven that increased trading is hazardous to one's prospects of investment success. In summary, while financial advisors should concern themselves with prudence, cost consciousness, and caution for their clients, the transaction model usually motivates the exact opposite behaviors. AUM-based fees. AUM stands for Assets Under Management, where the fees are paid as a percentage of the total amount invested. Advisors sometimes refer to this fee structure as flat fee or fee only, though there's really nothing flat about it as the fee rises in line with the assets. What advisors generally mean by calling it fee only is that they receive 100% of their income from clients and that they don't charge any commissions. Recent data suggests that roughly 79% of advisors' compensation comes from this type of model. Once again, these fees vary firm to firm, advisor to advisor, even within the same firm, and even client to client with the same advisor. Challenges. I have always struggled with the industry's infatuation with AUM-based compensation for advisors. For one, in no other service are you asked to step on the scale to ascertain the cost. Why should a $40 million investor pay $400,000 in fees when a $10 million investor pays $100,000 in fees for the same exact portfolio and the same exact utilization of the advisor's time and resources? Usually, the more you pay, the more you get. But in finance, you could pay more and get nothing in return. As a consequence of the AUM model, investors may not give much thought to how much their advisor is actually being compensated. Since most investors don't physically write a check every month, they barely notice the funds leaving their account. This AUM model blunts the impact of the salaries being paid out because percentages may seem less significant. Investors need to look at fees as salaries paid to their advisors. So if an advisor is earning 1% on a $10 million portfolio, one needs to ask themselves on a regular basis whether the advisor has earned their $100,000 salary, no different than any other contractor or employee. Time-based and project-based fees. Project-based fees is where the advisor is paid for the completion of a specific task or for receiving some project-oriented advice. For example, created an asset allocation model, or developing an investment policy statement, or conducting an asset manager search. Time-based fees is where the advisor is paid either an hourly fee or a retainer covering a specific period of time, where the advisor serves as an ongoing resource for investors. My firm belief is that the ideal compensation structure should be commensurate with the value that people bring and the time they spend. That is why a family's trusted advisor is often an accountant. An accountant does not take a percentage of tax savings, nor does a doctor who saves a life take a percentage of a patient's future earnings. So why should financial advisors be any different? While no fee model is perfect, and the time or project-based models have their challenges, it does appear to be the best aligned with the value provided. That is why the pressure for advisors to adopt these practices is rising. There are only a handful of us who currently adhere to this model today, though research by CLUELESSNESS suggests that 16% of advisors expect that in the years ahead, their compensation will come primarily from retainers, hourly or annual fees, a large increase from previous years. Now let's turn to asset management fees. Asset management fees. Asset management fees are paid for a variety of items such as security selection, capital allocation, or sticking to an agreed-upon mandate determined by the investor or the investment manager. And just as we saw with investment advisors, when dealing with asset managers, we have to be extremely careful about which behaviors the fees are incentivizing. Fees of investment managers should be approached differently than advisors, in part because investment managers have their hands on the assets, and the performance buck actually stops with them. They are more actively engaged with risk and generally on the hook for everyone's capital. As such, good managers, good investment managers, tend to be compensated more for their activities. This is no different than a real estate developer being better compensated than someone adopting a good buy and hold strategy. Since they are more engaged with risk and more could go wrong, their rewards for success are greater. Asset managers usually receive their compensation in some combination of these 5 categories: management fees, performance fees, cost pass-throughs, supplemental fees, hybrid. Let's start with management fees. Management fees. Much like with some advisory fees, these management fees are based on assets under management. Among other things, the reason that assets under management fee structure may make more sense for asset managers is because a flat fee is unlikely to work. Just imagine if XYZ fund started to charge a flat fee of $5,000 for investing in its fund. What would happen is that multiple groups would form partnerships, effectively making them one investor in the fund. This would be unsustainable for the fund company, and they'd quickly find themselves in financial difficulties. So the AUM fees make more sense for asset managers than for advisors. Performance fees. While they vary across asset classes, performance fees are usually as simple as paying the asset manager a percentage of the profits, which are meant to incentivize greater returns. The key for performance fees is that they are paid only after investor capital is preserved and/or the investors have been compensated for the risks that they've undertaken. For example, in most liquid funds with performance fees, they have a high watermark, which protects the investor from paying performance fees on what is actually their capital. And this could happen if, let's say, a fund drops in price significantly and then starts to make positive returns. The investment manager should not collect any performance fees until at least the principal of the investor has been restored and excess profits have been earned. And for many real assets and private equity opportunities, performance fees are not paid until the investor has achieved a hurdle rate or a preferred return. In other words, a specific minimum return, or until after the investors have received all their capital back plus a minimum return. Cost pass-through fees. While some funds utilize the management fee to cover all of the expenses, others simply pass on the actual costs of operating the fund to their investors. These may include costs of custody, trading, foreign exchange, legal fees, etc. And in some ways, this is the most appropriate approach as it allows managers to spend whatever it costs to make money for shareholders. This would be theoretically no different than investing in a business or company. Some businesses are capital intensive, some are capital light, some have thick margins, some have thinner ones. Having said that, this model can be ripe for abuse, where expenses and salaries are inflated, so it needs to be monitored extremely carefully. Ancillary fees. On top of all the fees described, investment managers will often charge ancillary fees. And I'm not talking about chump change. Researchers suggest that these supplemental fees may be as high as 40% of the total fees charged. In some asset classes, these fees are standard. For example, in real estate, there are acquisition or financing fees. In mortgages, there are origination fees, etc. Though in many cases, ancillary fees are unjustifiable cash grabs preying on the ignorance of most investors. It's also important to note that some of these fees may not even be fully disclosed, requiring investors to poke around or to ask directly about them. One such example is soft dollar arrangements, which don't need to be disclosed and yet could present a conflict of interest. An example of soft dollar arrangements could be an agreement between a particular brokerage firm and a particular money manager, whereby the money manager receives some special benefits, say free computers, in exchange for marked up brokerage commissions charged to the clients. It is therefore important to ascertain all direct and indirect methods of compensation. This leaves us with the question of how do we determine the return on fees? How do we make sure that our money is being well spent? For starters, we have to be clear on the three components of investment returns: the risk-free rate, the beta, and the alpha. The risk-free rate usually refers to 90-day T-bills or treasury bills and is controlled by the central bank, not the investor. And of course, it can move up or down significantly. Beta is simply the market return or the return of the underlying benchmark. For simplicity's sake, think of beta as the average return of the whole market, not the smartest nor the most foolish participants, the market as a whole. Beta can be purchased very cheaply by buying the index, such as the S&P 500, and can cost as little as 10 basis points. And finally, we have alpha. Alpha is the skill-based return, above and beyond the returns provided by the market. This is, of course, the most elusive and expensive portion of the return. The return on almost any investment is the combination of the risk-free rate, the beta of the market, and the alpha generated or lack thereof. And without the ability to isolate these three components, you may find yourself paying alpha prices for beta results. In other words, grossly overpaying. The reality is that most people overpay, as research suggests that at least half of market participants are copycats. In industry parlance, they are referred to as index huggers, who make their living by selling you expensive beta. Investors think they are paying for talent, but getting a replication of a low-cost commodity. And the overage isn't trivial either. In Canada alone, the amount by which investors overpay for beta, for the market return, exceeds $2 billion per year. Trend in fees today. Notwithstanding the concerns I've raised, we are seeing many positive trends with regards to fees. First, we are seeing a renaissance of transparency. Historically, advisors were under no obligation to disclose all the ways they were being paid. All that is changing. Disclosure rules around the world are forcing advisors and asset managers to disclose total fees. Investors are demanding to know more, and shady characters have fewer places to hide. Second, ETFs, exchange-traded funds, index funds, and other passive vehicles are continuing to take market share from active managers. They are also making investments cheaper and cheaper. Because the ETF business is extremely scalable, as assets get bigger, ETF sponsors are able to drop their prices to the point where even a single basis point can be meaningful. A similar phenomenon is occurring with transaction costs, where the actual cost of clearing a trade is now a fraction of a penny. So brokerages can soon offer free trading by focusing on other revenue streams. Third, fees are now negotiable. Once we recognize that some forms of fees are merely an issue of scale, not a function of cost, as the advisor isn't spending one more iota of resources on a $15 million account than they are on a $10 million account. It becomes clear that fees are somewhat negotiable, and many institutional investors are renegotiating their fees, and large private investors should probably do the same. Fourth, various technology solutions, such as robo-advisors, are disrupting the industry. Today, you could find a number of robo-advisor services for fractions of 1%. And in some cases, there's even a live human on the other end of the line. This is a fast-growing market, and there are estimates that by 2020, robo-advisors will be managing in excess of $2.5 trillion. This is all great news, as there has never been a better time to be an investor. Though before wrapping up, I think it's also important to mention when failing to pay fees is detrimental, leading to behaviors that are penny smart and pound foolish. The do-it-yourself investor. In an ideal world, everyone would do their own investing. Just like in an ideal world, you may paint your own house, grow your own food, or knit your own clothes. In the real world, however, we all focus on what we do best and leave everything else to the specialists. The problem is that when it comes to knitting a sweater, you realize pretty quickly that it doesn't quite fit. Whereas in investing, people often make mistakes they didn't even realize they're making and may not see the costly consequences of that for many years ahead. Fees as a two-way street. While we are deeply concerned about the investor not getting fleeced on fees, if you are thrilled with your advisor or asset manager, you should be equally concerned about them not earning enough. If their fees are too low, they may not be able to continue doing the work or delivering the returns you appreciate. They may be forced to take on more clients or more assets and possibly crowding the attention or the returns you have come to enjoy. There is no formula for what is sufficient, but be thoughtful and considerate in this regard to ensure that you are getting top-tier service at a fair price. Greater talent is more costly. Hiring investment talent is not a commodity. If you are hiring the top corporate lawyer, top cardiologist, or top-tier CEO to run your company, you can expect to pay top dollar for the privilege. It is no different with investing. Top talent will demand top fees. Now, obviously, the more frequent mistake isn't paying too much for talent. Rather, it's failing to recognize that the person you hired isn't the top. Nevertheless, it is important to remember that bargain basement prices and high-quality counsel rarely go hand in hand. Lastly, fees are not the most costly consideration. As this graph suggests, many more mistakes are made in these other domains. Investor behavior, lower costs do not prevent overconfidence, short-term thinking, emotional decisions, herd mentality, or any of the other behavioral biases that are much more powerful in the long run. Asset allocation. We know that asset allocation is the primary driving factor behind portfolio performance. Manager selection. Infinitely more money has been lost due to bad decisions than improper fee schedules. Likewise, low fees should certainly not sway one's decision to invest, because low fees with a bad investment is like having a well-manicured lawn in front of a teardown. Taxes. If your portfolio generated a mid-teen return in the market last year, between income and capital gains, you're paying over 5% to the taxman, far exceeding average fees. The bottom line is, fees aren't necessarily the highest priority in terms of absolute dollars. But as these arrows here show, it may be the highest priority because of the behaviors that fees inspire. Since fees permeate every facet of the pyramid by incentivizing various behaviors, how the fees are paid is considerably more important than how much. Summary. We talked about incentives being the greatest drivers of behavior. You get what you pay people to produce. We discussed that most investors don't have a clue as to how much they pay and how it affects them. We showed that fees actually eat up 25 to 50% of the average investor's retirement savings. We talked about investors needing to always disentangle advisory fees and services and asset management fees and services. We talked about the pros and cons of various advisor fees and various asset management fees. Ensure that your fees perfectly align with your interests. When comparing fees, always ensure that you're comparing to peers in the same asset classes. We talked about the 3 factors of return, the risk-free rate, the beta, and the alpha. Only pay a premium for alpha, pay market for beta. We said that today is the best time in history to be an investor, with greater transparency, lower cost, more regulation, more access, etc. We said that there are higher priorities than fees. The cost of doing everything oneself rarely outweighs the benefit of not paying fees, as mistakes with behavioral biases, asset allocation, manager selection, and taxes can come at a much greater price. We said that in the end, fees may be a leading consideration because how fees are paid will likely impact your portfolio more than how much it actually cost you.